Hi everyone. Today we're going to discuss the 6 things that you must know in order to make the most of your employee stock purchase plan, also known as your ESPP plan, especially if you want to pay less in taxes and keep more of your gains. Let's jump into it. The first and most important thing to understand about an ESPP plan is exactly what it is. An ESPP plan allows employees to buy company stock, typically at a discount, using after-tax payroll deductions. Now, the typical discount works out to be about 15%, which is essentially free money. But here's the key. The discount and the holding period have major tax implications. Know the key 2 dates, the grant date and purchase date. This is where tax planning officially begins. The grant date is the day that your company officially chooses to offer you the ESPP plan and you choose to enroll. This is where you decide how much you want to deduct from your paycheck. Typically, it's going to be in the range of 1 to 15%. This starts what's called the offering period, which can last up to 27 months. The 2-year clock for tax efficiency begins ticking from this date. Next up are payroll deductions, taken out after tax from every paycheck. This is where your company accumulates those values until the next key moment. The purchase date. The purchase date is when your company takes all those contributions and buys company stock on your behalf. The perk is that you typically get a 15% discount. And many companies have a look-back feature which grants the discount to the lower of the stock price between the grant date and the purchase date, which can mean instant gains. From here, the 1-year holding clock starts ticking. Remember, if you sell too early, you can increase your tax liability, so timing matters. We're going to talk about the qualified and disqualified dispositions next, but just remember this. The grant date starts the 2-year rule, the purchase date starts the 1-year rule. All right, so the third thing that you must know about an ESPP plan is the difference between a qualified disposition and a disqualified disposition. So here's where a lot of people get tripped up, but I'm going to break it down nice and easy for you to understand. So a qualified disposition is when you sell shares at least 2 years after the grant date and at least 1 year after the purchase date. The result is your gains are taxed at capital gains, which means that you can have significantly more savings from a tax liability standpoint. A disqualified disposition is when you sell shares too soon and you fail to meet both requirements. Your result is that your gains are taxed at ordinary income, which can mean that you pay significantly higher in taxes. So the fourth thing that you need to know about the ESPP plan is how the discount is taxed. Now, this is crucial and can be a little bit complicated, so I'm going to break it down further for you. Let's say that your ESPP gives you a 15% discount and the stock is $100 when you purchased it, meaning that you bought it for $85 because of that discount. In a qualified disposition, the lesser of the discount or gain from purchase price to sale price is taxed as ordinary income, and the rest is long-term capital gains. In a disqualified disposition, the difference between the purchase price and the market price on a purchase date is taxed as ordinary income, even if you don't sell right away. So let me break this down further so that way you have a visual and you can better understand how this works. Here's a quick example to make it simple. Let's say that this stock is $100 on both the grant and purchase dates with a 15% discount. You buy it for $85 and later you sell it for $130. If you meet the holding period, in other words, it's a qualified disposition, the $15 discount is taxed at ordinary income, and the $30 gain is taxed as long-term capital gain. If you sell too early, in other words, this is a disqualified disposition, that $15 discount is still taxed at ordinary income. But now, guess what? That $30 gain is also taxed at your higher income tax rate, not capital gains. That difference in timing could cost you hundreds or even thousands of dollars at tax time. The fifth thing that you need to know about your ESPP plan is that you must keep a detailed track record. Now, your employer may not keep accurate records of your cost basis, especially if you're buying at a discount. So you must keep track of your grant date, your purchase price after the discount, and the sale price and date. This will allow you to report your cost basis accurately and avoid overpaying. All right, we finally made it. Rule number 6, create a tax-efficient strategy. Here's a golden rule. If you need liquidity or you believe that the company is overvalued, it may be worth selling even if it's in a disqualified disposition. However, if you can wait, qualifying for long-term capital gains can save you thousands. If you need to, speak with an advisor or an accountant so that you can better understand your goals, your income, and your risk tolerance. All right, if you made it this far, then you'll understand that ESPP plans are one of the best benefits a company can offer. And oftentimes they're misunderstood. By better understanding these plans, you can make the most of it and walk away with the most amount of value. So I want to dedicate this video to my cousin EJ and his co-workers at Tesla. Hopefully you found value in this. If you want to watch more videos like this, please remember to follow, like, and comment, and I'll see you next time.